Hey, Brandon, before we get started, Alan's got me drafting this reverse triangular merger document, and I can't figure out how I'm going to allocate GST exemption. We're going to do a reverse triangular merger in the middle of a gift. Should I hang the crummy powers, or should I let them lapse after the 60 days?
Great question.
I'll tell you what, I'm so tired of filling out time slips and covering for Alan when he's on the phone and puts the people on mute and asks me what's going on. I think he's losing it, but I'm glad I can be here to help. I'm looking forward to going to the University of Miami Institute to kind of figure out what you guys are always talking about. Oh, all right. Let's start the webinar. And I apologize that my camera keeps disappearing on me, so I can't see what angle the audience is looking at. That's not a bad angle. Okay. Enough already with the estate tax planning questions and answers. This is our third consecutive week, and for many of you, it probably seems like 8 or 9 weeks. But we keep having questions come up, and we keep enjoying actually giving these presentations. So thank you for enjoying the invite. I know that it really increased my stature as a professional in the minds of many of my clients and colleagues. And next Saturday, we're not going to do any more darn questions and answers. We're going to talk about spousal limited access trusts, how to keep your slat from going kersplat. So Brandon will be here if he's not too busy playing golf or being a father, and I'll be here because I don't play golf and my children have abandoned me. We want to point out there is on YouTube a video that you can pretend to be watching when your spouse comes up and says, "What are you watching on YouTube?" And you just click right to this video. And Ken Crotty will be talking about qualified personal residence trusts and GRATs. And if that doesn't put you to sleep, nothing will. Tuesday, April 27th, in the not so free category for you real enthusiasts, CPAs, tax lawyers and actuaries, we're joined by Jerry Hash on the LISI network, and we thank LISI for letting us use LISI materials in this presentation today. So, Brandon, I wanted to show this to you. I had a really good call yesterday with a very, very bright guy in his early 30s, and he's hit a couple of triples already, and he may be looking at his first home run. So, he's got a net worth, I would say, in the $5 million range, but based on his track record and the project he's working on right now, that could easily be 10 to 20 to 30 times that. And he's very forward thinking. So as with another client, who's one of my good friends, about 30 years ago, he did an irrevocable trust before he had a spouse or children. And he said, I want to make sure I save estate tax, so go ahead and set up the irrevocable trust. I'll put the assets in there. And when I have a spouse, she'll become a beneficiary. And when I have children, they'll become beneficiaries. And if I divorce the first spouse, then the second spouse will become a beneficiary. We call that a floating spouse provision. So what he and I have talked about is to set up what we call a complete gift trust. So it's going to be out of his estate for estate tax purposes. He's going to transfer about $3.5 million worth of assets into this irrevocable Nevada trust for his mother, his sister, his nephews, and his nieces, and his future floating spouse and his future descendants. Now, I don't know if his descendants will be able to swim or not, so I don't know if they'll be floating. But then he doesn't really want the Nevada trustee to have to do a lot of work. So we're going to set up a limited liability company. And if we set this up in Nevis or Wyoming, it may be very hard for creditors to reach, even if they could get through the gift trust. And then he's going to put $3.5 million of investments in there. He was going to put only $2.5 million, but I said, why don't you put in $3.5 million, take back $1 million note, bearing interest at 2%. And then if somebody sues you, all they're going to be able to get is a note bearing interest at 2%. They have to wait 30 years for it to balloon. So that could be a good creditor protection instrument. And also, if you do well on your new deal, then the $3.5 million of investments will grow. Maybe it's 7 or 8% a year on average, and then the promissory note's only bearing interest at 2%. So you will have the arbitrage. And he's not French though, so he didn't really understand the arbitrage. So I called it the delta. And he doesn't fly airplanes, so he didn't understand that either. But then I said, you know, if you're concerned about the creditors taking hold of that note, let's put it in a second Nevada trust, an incomplete gift trust. It gives you the creditor protection to the extent that Nevada gives you that, but your creditors can't take the note. So he thought that was a pretty good idea. I somehow made him think that it had been his idea instead of my idea. But then we got to the most important thing, and that's the stock in NewCo. Now, I was really surprised to know that the name NewCo was available for a company. But we think the stock is worth about $5.5 million, and in 2 years, it's going to be either 0 or 50 to 100 million, according to him. So, and I believe him based on his track record and his knowledge. So I said, okay, let's put NewCo in an LLC that you can control under another complete gift trust, take back a $5 million note. That's only going to be considered to be a $500,000 gift for gift tax purposes. And if NewCo goes to 100 million, then you'll get your 5 million back, and you'll have 100 million out of your estate for estate tax purposes. And he said, no, I can't do that, because then I won't have any money to pay my taxes on the sale. So, okay, we'll let you keep 40% in NewCo in case capital gains rate goes up to 40%. And we'll put 60% of NewCo in this LLC. And then he said, but wait a minute, I need the 5 million no matter what. I mean, I just don't feel comfortable giving that much away. Okay, we'll take back the $5 million note. So if NewCo sells for 15 million, you're going to get 40% of 15 million. You'll pay your capital gains tax with that. The 60% of 15 million will go into the complete gift trust, which will give you another 5 million. So then you'll have $5 million, and then in the incomplete gift trust, which can buy you a house, pay for your wedding, and allow you to live happily forever after. You might have to live in your car if you are going to try to live on $5 million and you spend a lot of money, but it will be happily ever after with your spouse or the next one who will happily be beneficiaries of these complete gift trusts. Brandon, any questions, comments, or suggestions on that?
Yeah, no, I think it's a great plan. You know, very effective from an estate tax planning and also an asset protection planning standpoint as well. So it captures the best of both worlds there.
Yeah, I was pretty happy with it. I hope he likes it. I get to send him a bill now for describing it to a lot of people. So I like that also. Now I'll just show you another one that we had. This was a big week for startups. This client is a physician, and he has a really cool invention. And based upon what people are paying to invest in his company, it's worth 80 million. And it will hopefully be worth 200 million when they merge with a public company. So what he's done is we put a complete gift trust together. Again, an LLC. This one may be in Nevis because it's really hard for creditors to reach a Nevis LLC, even if they could pierce a Nevada trust. Put 30% non-voting interest in NewCo into this LLC. Now, 30% of 80 million is 24 million. And then I take a discount for lack of control, lack of marketability because it's non-voting. It's only 18 million. And then he takes back a $16 million note. So he's only made a $2 million gift. But now when NewCo is worth 250 million, the trust has 40% of 250 million, or if it sells for 200 million, the trust has 54 million, pays back the 16 million, and ends up with tens of millions of dollars estate tax free based upon only a $2 million gift. If NewCo blows up and goes kerpuff or doesn't sell for much, he's going to get the first 16 million for those shares in NewCo. He's keeping 40% of NewCo so he can pay his taxes on the sale. And then he's putting 30% of NewCo in an incomplete gift that will be subject to estate tax, but will be easier for him to get hold of. So that's pretty much the same thing. So Brandon, the question we get the most is basically, what did you guys say? What did you mean? How does this work? So this is a very common arrangement here we have on page 8, where a client has, let's say, $20 million worth of assets, and they don't want to be taxed on $20 million worth of assets. So they put the $20 million in an LLC, and at first they own 1% as the voting members and 49% each as the non-voting members. And then John sets up a trust for Jane over there on the left. John funds it with a seed capital gift. It is held by Jane as trustee for the health, education, and maintenance of Jane and the descendants, and it will never be subject to estate tax or creditor claims of John or Jane. Under Florida law, this works in all 50 states. And then what happens, Brandon?
Yeah, so then you really wait until the asset under the LLC is sold, whether it continues to grow in value. You pay annual interest payments each year on the value of that note. So I think this one is right around 1.35%. So there would be annual interest payments paid back to John from the SLAT trust. And then, after 15, 20 years, let's say the asset has grown to $40 million. So now if you take 49% of 40 million, that's right around 20 million, but it only owes back a $6-7 million note. I can't quite read the value of the note there, but there is a large equity value in the SLAT even after the note's paid. So it could prepay the note. It could, wait till the 20-year term is over and play the balloon note at that point in time. But there's going to be a large equity left in that SLAT trust, which will be outside of your estate, and you've effectively frozen the value of the LLC from day one, and all the appreciation above and beyond that interest rate has passed to a trust that's outside of your estate for estate tax purposes.
Great. Okay. So in other words, I took 20 million of assets in the LLC. I gave John 49.5% non-voting interest. You would think that that's worth almost 10 million, but it's actually worth probably about 6.5 million if you take a 35% discount, which is not unusual. So now instead of 10 million worth of assets, John only has a $6,500,000 note, and instead of the assets growing at 7 or 8% a year, or maybe more, maybe less, it only grows at 2% a year for John, and all the excess growth goes to that nice trust. And John and Jane will happily pay all the income tax on income earned by the LLC. And this will all be grandfathered, at least according to the Bernie Sanders bill. If you set this up before his bill is passed, then it is grandfathered to continue to allow John and Jane to pay the estate tax, to pay the income tax on the trust income, which is a big, big, big deal when you run the numbers over time. Now, usually a tax law becomes effective on the day that it is proposed by the House of Representatives Ways and Means Committee, and that is what I would expect. So we may not have this kind of warning. Any week now or any month now, there may be news that a bill came out of the House Ways and Means Committee with this provision in it, and then it may be too late to put this in place. So that is why SLATs are so darn popular. So Brandon, it's probably good for the audience to see this again. What does Jane do?
Yeah, so Jane would actually set up a trust for the benefit of her children only. And the reason why we can't have Jane set a trust up for her spouse and the kids is because then we would have a reciprocal trust issue. So when you have reciprocal trust, meaning I create a trust for somebody and that same person creates a trust back for me, creditors can reach into the assets of that trust, and that would likely make it subject to estate tax. Now, there are some planners that do recommend reciprocal trust and how you can get around those. Maybe you set them up at different times. Maybe you have slightly different beneficiaries under each trust. But that's a risky plan. We're not entirely sure that works. So we don't set up reciprocal trusts. We just have the spouse fund a trust solely for the descendants only, and the spouse is not a beneficiary. So then the same type of planning occurs. You have the asset that's worth $20 million, that 49.5% interest isn't worth 10, it's worth a discounted value off of that 10 because of lack of control, lack of marketability. You have a non-voting interest. So the note back to Jane might be $6 million. And then you have the same type of growth where you freeze the value in Jane's estate, and the growth passes to the descendants trust above the stated interest rate. And this, same results apply as it did under the SLAT, just the spouse is not a beneficiary, only the kids are the beneficiaries.
Please do think ahead when you design these documents. For example, if there was a divorce, would the SLAT divide into two, one trust controlled by John, one trust controlled by Jane? Would the descendants trust do the same thing? How do you control a trust? Well, you just control the right to determine who the trustee is. The estate tax law allows that as long as your trustee that you would add is not related or employed by you. So if there's a big trust for my children and the trustee has the discretion to withhold money or pay it, and I have the ability to replace the trustee with my best friend from college or law school, who I'm not allowed to see anymore, but if I was able to see them, they maybe could be the trustees, then you have that indirect control. But it's not a bad idea to also say that the trustee could make distributions to charity in case you decide to disown your children and give monies to charity anyway, or in case the tax law changes, and that may be a good idea. Now, another question we get a lot of from our clients is, what in the heck is the purple trust on the right, and why do I need it, and why does it own 0.1% of my LLC? Now, the question we get from tax professionals is, how do you get around the Powell case and the Strange case and Internal Revenue Code section 2036A2? Now, Brandon and I always like to have the Internal Revenue Code section of the day, and today's section is 2036A2. So, Brandon, do you want to answer that question? Because I forgot what the answer is.
Yeah. So essentially what 2036 says is if you retain the ability to shift the beneficial interest or control when distributions or when a liquidation can occur under that LLC, then the IRS has taken the position that we can now include the value of that LLC into your estate, regardless of the fact that it's held under these irrevocable trusts that are outside of your estate. And that's the Powell case, that's the Strange case. So what we've done is we have a special trust set up, and usually we call it the special voting trust or the distribution control trust, or we get really creative with our trust names, as you can tell. So we give those rights to liquidate the LLC, to make a distribution from the LLC, to amend the operating agreement of the LLC. We give those to this special trust, and we have someone other than John or Jane, the grantors of the trust, the clients, or anyone that has control over as an agent under their power of attorney. So really, we like to have this to be an independent person, might be a CPA, might be financial advisor, might be a really close friend that they trust, that isn't under an agent under their power of attorney documents. So they keep those rights. That way, John and Jane don't have those rights. And that's how we avoid that potential issue with Powell and Strange and the 2036A potential inclusion, because of retaining the rights to liquidate or make a distribution from the LLC.
And I know what everybody's thinking. Everyone's thinking, wow, I would love to read an article about 2036A2 and how to avoid the Powell case. And if you just send us an email and in the RE line, put 2036, little a in parens, open parens, 2 in parens, close parens, we will cheerfully send you that article. All right. So in here we show, this would have been a better thing to show, but page 9, you put 20 million in the LLC, and then you value 49.5% at 6,000,009, So at the end of the day, instead of owning 20 million, this couple is owed about 14 million, and it does not grow in value, and they use the payments on the notes to pay the taxes under the LLC. And then you could also have the note, instead of bearing interest at the low rate, it could bear interest at a higher rate and automatically be forgiven on death and not be in the estate. So if you are in poor health and or not optimum health, and you think you might die before the normal life expectancy of somebody your age, then you can talk about setting up what's called a self-canceling installment note. So that's that. All right, we had promised to, and we have a lot of questions that we're going to answer today, and we'll probably go a little bit over past 11:30. But the doll charges me overtime, so we can't go too far over. But Brandon, what is a Cupert, and why would I want one? I mean, it sounds really cute. It's just a great name.
A Cupert is the acronym stands for a Qualified Personal Residence Trust, and essentially what this is a way to reduce the estate taxes that you might pay on your primary residence, and you can also do this with one other residence. So you have you can put up to 2 residences into one or more of these Qualified Personal Residence Trusts to potentially save estate taxes. So walking through how this actually works is you set up a trust, you put the personal residence into the trust, you retain the right to use that residence for a number of years, whether it's 10, 15, 20 years, however long you decide to set the term. And then once that term expires, the trust actually and the house passes to a irrevocable trust that's considered to be outside of your estate for estate tax purposes. So you've essentially then made a gift of the remainder interest in the house at the time that you set that up to this trust that's going to be outside of your estate. The benefit of that is, again, we're really almost freezing in a way the value of the asset. So we'll go through some details as to how it works and how you value this. The downside here is if you do not survive the term of the trust, and that retained term, then the residence is included in your estate. But it's no harm, no foul. You get a reduction off of your estate for the gift taxes that you paid when you funded the trust. So you're in the same position that you otherwise would have been, but of course, we do like to survive that term and make sure it passes outside of your estate. And then once you survive the term, you actually are required to pay rent to continue to use the residence. And that's not going to be considered a further gift to the trust. So you're reducing the value of your estate by paying rent for the right to use the residence. You can also pay the expenses associated with the property. So this works really well from an estate tax planning standpoint. Now, to get through some numbers here, and this works really, really well when you have both spouses essentially transfer their 1/2 interest in the property, because then you can take a discount when you're valuing the home because of that 50% interest. You're not transferring a whole house, you're only transferring half a house, and someone's not going to want to pay full fair market value for just half a house. So walking through an example here, we have a home that's worth $2.14 million, so 50% of that, $1.07. We can take a 15% discount on that for the valuation. So really the house is worth $900,000. If we set this up for a 15-year term, we're essentially making a gift of $443,000. That's the remainder interest that's going to be left after I use the house for 15 years. So we can pay gift tax on that amount.
No gift tax payable, just report part of use of the exemption.
Yeah, so you'd use part of your exemption to report that gift. So you reduce your $11,007 estate tax and gift exemption during lifetime. The residence would grow at 7%, so it might be worth $2.5 million at the time that 15 years has expired. So what have we done? Well, we've made a gift of $443,000 when really at the end of the term, the house was worth $2.5 million. So what we've done is we saved $826,000 of estate taxes. If it continues to go for another 25 years after that, we're up to almost $1.8 million in estate taxes. And that's not including the rent that we can pay that would further reduce our estate. And so if you look down here in the box, you can see for paying the rent through years 15 through 25, we can save another $1.1 million based upon that rent, totaling up to $2.7 million. And that's going to be 8% of the value of the residence was our assumption on the amount of rent paid. So you can see how effective this is. It's a good way to continue to live in your home, but also have that home pass outside of your estate and save estate taxes. And if you want to sell the home, you can replace it with another home. There's no issue there. If you have a vacation home and you just want to get rid of that, then the QPERT can actually convert to a GRAT, which can work in a similar fashion. And so you don't have to worry about locking yourself into any one particular residence. There's some flexibility and also very nice estate tax savings. So Alan, anything to add there on QPERTs?
Yeah, let me just, I'm sure a lot of people followed you and a lot of people didn't. So I'll just go over it again, sort of my elevator speech. So assume I'm 56 years old and that Marcia and I have a house worth $2,140,000. I take my half of the house. Now I'm going to take the guest bedrooms, the pool area, the living room, and the office. I'm going to give Marcia the formal dining room, and I'm going to give her the master bedroom suite, and I'm going to give her the whole front yard. So I'm going to take my half of the house and I'm going to put it in a trust. And the trust says that for 15 years, I can use the house rent-free. And after the 15th year, I am no longer able to use the house rent-free, but that trust is held for Marcia's lifetime health, education, and maintenance, and she can redirect where it goes when she dies. So in essence, it doesn't affect much. And my ability to pay rent after year 15 enables me to reduce my estate further. At the same time, Marcia takes her half of the house and she puts it into a QPERT just for our descendants. For two reasons. One, she doesn't like me. And two, the reciprocal trust doctrine. Now, we don't have to use the same number of years. Marcia will probably outlive me by 10 or 20 years. I like to use a number that you have about an 80% chance of making. So if I'm 56, my chances of making it to 66 are 90%, you can see there. But my chances of making it to 71 are only 19.43%. So that is the QPERT. Now, the 7% growth rate, I will say, that's not happening in real life. Houses go up by an average of 3 to 4%, because remember, the home gets older every year. The house part is older every year. So houses are not typically a great investment, but this is something, the first thing we ask the client is, are you going to live in this house forever? And a lot of them say, yep, you're taking me out of there feet last or feet first. I don't know how it goes. I don't remember. But if they sell the house during the term, the trust can either buy them a new house or it can hold any excess money and use it to pay them annually until that term ends. So it's Brandon called it like a GRAT. It's like an annuity trust, because a GRAT is like annuity trust. So that's the story of the QPERT. And the reason we bring it up is we're seeing a lot of couples now who are trying to get under 7 million just in case, because if it doesn't happen now, it may happen after 22, it may happen after 24. And this is, something that you don't have to do much with. Once you put it in the trust, tell your insurance agent it's in there. The property appraiser allows you to keep the homestead exemption. Even when you're renting it, you get the homestead exemption because you make it a 98-year lease. So it's pretty unintrusive. So Brandon, what about the irrevocable life insurance trust?
Yeah, so this is another, common arrangement that we see, where you take a life insurance policy and you put it into an irrevocable trust. And, the simplest arrangement is to have the premiums paid each year by making gifts under the annual exclusion amount. So the ILIT might be set up for the benefit of your 3 children, have $1 million policy, and then each year dad can contribute up to $45,000. That's $15,000 per year per child. That's not considered to be a gift at all. It's excluded under the annual exclusion. And that money can be used to pay the premiums on the life insurance policy. Dad can't be the trustee of the trust, but there's nothing that would prevent mom from being the trustee. Mom could also be a beneficiary here if wanted to be set it up as a SLAT. There would be no issue with that as well. So this can work well using the annual exclusion amount to fund life insurance premiums. I think the idea here, though, is if you have an existing policy, you have to get it in the trust more than 3 years before you die. Otherwise, it can come back into your estate. Or alternatively, you could actually sell the policy to the trust and receive back, an equal amount, and that would not be subject to the 3-year rule if you sold it to the trust. So a couple of different planning ideas there. Now, and I think one question is, what happens in the event that the premiums are larger than the annual exclusion? Is there still a way that we can really fund the trust and use maybe a loan to pay those premiums?
Right, and that's where we go to split dollar, which I will say the life insurance industry has more loopholes and tax advantages than any other industry. So I could put money into my life insurance trust, keep the life insurance out of my estate for estate tax purposes, let it benefit my spouse and my descendants, and at the same time have the right to receive the money back from the policy if it's cashed in by making what we call split dollar advances. That's a fancy name for I'll put money in and I'll get the first money back out. And a lot of clients have, say, $2 million life insurance policy with a $300,000 cash value, and they plan to retire on that cash value. They could put that into an irrevocable life insurance trust and have the right to get the first $300,000 back out. So that is split dollar life insurance. And we're not great lovers of permanent life insurance policies. I think a lot of clients think that these permanent policies have a higher rate of return than they actually do. But if you have even a term life policy and you don't want to pay estate tax, all you have to do is put it in a life insurance trust. And you know what? If you change your mind, you just buy it back out of the trust and put it in another trust, which happens pretty often. People change their mind and relationships change. So that's what you do. So let's go to, and by the way, here's some relative interest rates. So Fred is 66 years old. He could loan, this was in January, he could do a 20-year note for a 1.35% or a 17-year self-canceling installment note for 4.2%. So if Fred is not in good health, he should sell all his assets or enough of his assets in exchange for a self-canceling installment note to get his estate tax down to 0. So we do tell clients that, if you're wealthy, if you get a bad diagnosis, you call your spouse first and you call me second before you call anyone else, so we can see if it's possible to put you into a self-canceling installment note or something else called a private annuity. So here are some questions. My father died in 2005. Sorry about that. But trust and estate tax were not filed or funded. My mother died in December 2020, and the estate is worth $20 million. Estate tax returns not done. What should I do? Go immediately to an estate tax professional. Usually an estate tax lawyer. There's a lot of lawyers who we spend a lot of our time doing estate tax work, and there are some CPAs who spend a lot of their time doing this. Get both so that they can work together, because you may have what's called disclaimer planning opportunities here, and you may have valuation opportunities which will be screwed up. That's a layman's way of saying which will be sacrificed or lost if you act. So especially when somebody dies, don't just run and change the IRAs and cash in the bonds and change the joint account, first see a lawyer or other professional, because there are some things that can be done before they're touched, and you only have 9 months to do these things. So anything come to mind on this, Brandon?
Yeah, no, that's the only, I mean, I was thinking portability, but I don't think portability was available in 2005, that you might be able to, get a letter ruling to get the portability amount, but I don't think that would apply for a death in 2005. If it was 2013, maybe that would be an option as well.
Right. Okay, next. Oh, by the way, for the other piece of advice I have, oh, your mother's already deceased. I was going to say, before she died, she could have married another person who died before her without using their allowance, and then she would have had both allowances. That's called portability, and that's why nursing homes are so busy now with people dating to try to get a new portability allowance. By the way, I have a father-in-law with a short life expectancy who's not married. You've all got my email address. I'll be glad to fix you up. Okay, if an irrevocable life insurance trust, being an entity with a social security number, is it required to file tax returns every year, Brandon?
Yeah, so the most life insurance trusts, or actually all life insurance trusts, if they own policy on the life of the grantor of the trust, are considered to be grantor trusts for income tax purposes, which means that all the income of the trust is actually taxed to and reported on the grantor's personal income tax return, so the Form 1040. So there would be no separate full tax return filed for the life insurance trust. You might have to file what's known as a grantor trust information letter. That's basically saying all the income of this trust is being reported over here on the personal Form 1040 of the grantor. Now, if the life insurance trust is just holding a life insurance policy, it's unlikely that it's going to have any income to begin with. So there would be no filing requirement when there's no income, regardless of whether it's a grantor trust or a non-grantor trust.
Right. We do recommend that the life insurance trust have a tax ID number. It's really not a social security number. It's called a tax ID number. And I think they're required to anytime you have a trust where the trustee is someone different than the grantor. But if you don't have one, I don't think anything terrible happens. All right, I'm 70 and a widow. My 3 children are in their 30s. One has 4 children. I've already gifted them $900,000. My assets are nearing 11 million. I have all these things. I want to give them additional funds for their future homes. Are promissory notes my only option? Well, I guess this trust with a 1.7 million, you could use that, although I'm not sure exactly what that is. You could also get a mortgage on your house. I know you don't like to borrow, but you could get a mortgage on your house, and it would only bear interest at about 3 to 3.5% if you got a $500,000 mortgage on your house, and you could use that. Or you could draw on the IRA, but when you do that, you're going to pay tax early. Maybe you should have your children go ahead and borrow money for their houses, but guarantee the loan. That might be another idea. Brandon, any thoughts on that? Now, you could marry somebody wealthy and use that person's money. That's popular here in Pinellas County, where our office is.
Yeah, I can't think of anything else other than what you've mentioned.
Right, and it is unusual to have a $4 million home, so I guess that's really good, but maybe you're in Los Angeles and it's a 2-bedroom, 1 bath. I don't know. Okay, I'm 71 and my wife is 56. So these people, when I added it up, they've got about $16 million worth of wealth, and they are perfect for putting the businesses, the property LLC and the C corporation into another LLC, and then selling that LLC interest to irrevocable trusts. That's going to work well for them. And we may go into more detail for these people next week when we talk about slats, because we can talk about how a slat would work well here, because you've got a husband who's 71, probably pretty secure that he doesn't need all these assets for the rest of his life. Then you've got a spouse 56 who has a long life expectancy. So you try to put most of what you do into a slat so that she's got that long life expectancy. And then you've got common children, so that that long lasting slat for the wife would protect the wife from the children taking the money from her, or from a future spouse trying to do that. Okay, my wife and I are the insureds of a second to die policy with our son as the beneficiary. Policies under an ILIT with independent trustees. If we need to fund a premium payment after December 31st, when the Sanders bill would not allow us to put more than $60,000 a year in, how will we do that? Brandon, I know you probably know the answer to that one.
Yeah, so this is an interesting one where I guess the way the current legislation is drafted, that all grantor trusts would be subject to estate tax. And so a trust that holds a life insurance policy on the life of the grantor is considered to be a grantor trust. So unless they're, and I assume the life insurance industry is going to be lobbying hard and pushing for this, for some exception for life insurance policies to not be included in estates since they're going to be considered to be a grantor trust. But I think it is a potential ongoing issue here. We'll just have to wait and see how the legislation comes down. And then contributing to that trust would blow the grandfather status of the life insurance trust. So that would cause it to be included in the estate. I don't know if a loan to the trust will be considered a contribution. So maybe you could do a split dollar type loan, and that would be considered a contribution that would blow the grandfather status of the trust. But we'll just have to wait and see what comes down from the legislation, and it's a little unknown right now, unfortunately.
Okay, so I want to go through some of the questions that we've received during the presentation. The first one is, are there 4 handouts or 3 handouts? And I'm sorry, Abigail, I don't know how many there are, but we'll email you. The second one is, can I get a copy of the slides, and where can I see a replay of this? Well, about 1 hour after we're done here, which is 1.5 billable hours in lawyer talk, you'll be getting from GoToMyWebinar a link that you can click on to provide us with a gratuity off of your credit card. No, actually, you'll get a link that you can click on to watch the video, and you'll also be getting the PowerPoint. So we do not accept gratuities, except in the form of food delivered to our office, which is always appreciated. All right, putting money into a not-for-profit foundation, can that be a way to move money away from your estate? Beatrice, absolutely. And sometimes when we do really aggressive planning for a family and we almost get them below the exemption amount, but not quite, we just have the client put the rest of the, whatever it takes to get her under the exemption amount into a family foundation. You get an income tax deduction, and you also have the ability to control those assets and use them only for charitable purposes, which quite candidly is a really good thing to do for your children. It teaches them responsibility, and it makes them feel good that they're doing good things for others.
Yep.
Okay, Tal had a good question. What happens to the step up in basis for the QPERT? And if you are lucky enough to die during the term of possession, you get the step up. If you die after the term of possession, in our opinion, you get the step up because of a nuance in the law, but most lawyers believe otherwise, and the Bernie Sanders bill would take away that step up. So you do make a good point. We're trying to save 40 to 45% in estate tax, but we may be costing the family 20% in capital gains tax or even more. If the capital gains tax goes up to 40%, I'm sure it'll come back down later, but that's a really good question. And something to think about also in our LLCs, where we're putting the $10 million in and shrinking the value to $7 million. Well, when the clients die, you may not get a step up. You probably won't get a step up the way the law is going. But do you want to avoid estate tax, or do you want to avoid income taxes? Can an estate not recognize a natural casualty loss but transfer the loss to the beneficiary? No, I don't think you can transfer a casualty loss for income tax purposes to a beneficiary. So let's do.
I think, Alan, one point on that, maybe in the final year of the estate, that you could pass out the unused excess exemptions to the beneficiaries, but I think that's another potential issue now, because I think those flow through as miscellaneous itemized deductions, which have been eliminated as part of the Tax Cuts and Jobs Act in 2017. Those might come back at some point, but currently I don't think that loss passes out. One other question I'd see that was a good question related to the QPERTs is, do you have to pay tax on the rent after the term of the QPIR when you are, paying rent to the trust, and no, because the trust can be disregarded for income tax purposes. So it'd be treated as if for income tax purposes, you're really paying yourself. So no tax owed on the rent.
Okay, while a slat for both spouses with 20 million combined net worth may be optimal for a married couple, you indicated you only use a slat for one of the spouses to avoid the risk of the reciprocal trust doctrine. Therefore, you often establish an irrevocable trust by the other spouse that solely benefits the descendants. Can this other trust be an ILIT, which is an intentionally defective grant or trust that solely benefits the descendants but retains all other benefits of the slat, such as gifting assets to descendants, paying the income tax on the trust, etc.? And the answer is yes. Thank you very much for this question. Alternatively, rather than establishing an irrevocable trust for the other spouse, what's the downside of simply having the other spouse put assets into the same slat? That's another great question, and that is, if I put assets into a trust for my own benefit, then that trust is going to be subject to federal estate tax in my estate in most states and in most circumstances. So that's why I would not set up a trust for myself. The only possible exception to that would be an asset protection trust that will definitely work. And when you're dealing with United States asset protection trusts, we don't know if they'll definitely work. Maybe this would work offshore, but I don't think the IRS would like it at all. So don't put anything into a slat that you are a beneficiary of. Okay, so we're going to cut it here. We apologize that we couldn't cover everything. We apologize that we went longer than we thought. Saturday, May 1st, I'll either be with Brandon or I'll be with this guy, and we'll be talking about spousal limited access trusts, how to keep your slat from going per splat. You do have our email addresses here. As always, you can send Brandon the hard questions, send me the easy questions, and have a fantastic day. Thank you very much. All right, turn it off now. We're done. I need to go get this thing drafted finally. You want it in Word or Word Perfect? See, it's a really hard time.